Welcome to InvestorHubX.com. Have you ever entered a trade and immediately thought, "Why did I even take this trade?" The problem is often not your indicator. The problem is trade quality. Today, I'll show you how professional traders filter out low-quality setups and focus only on high-probability opportunities. In this video, I'll show you what is trade quality, examples of a high-quality trade, an introduction to the trading diary. If you enjoy this video, don't forget to like the video and subscribe to the channel. It helps support the channel and allows us to produce more high-quality content. Let's get started. Trade quality refers to any factors that increase the probability of success of a trade. There are no perfect trades, and there are no guaranteed trades. There are only high-quality trades and low-quality trades. The more you understand this concept, the more you will start seeking high-quality opportunities and filtering out low-quality trade setups. A high-quality trade does not simply mean the price moves in your direction. It also means the trade offers a favorable risk-to-reward ratio and a stronger probability of success. But how do we identify high-quality trades? The more traits you have from this list, the higher the quality of your trade. The first factor is trend. In an uptrend, you generally want to focus on long trade opportunities because the market is moving in your favor. On the other hand, in a downtrend, you want to focus on short trade opportunities because trading with the trend increases your probability of success. The second factor is whether the trend is a fresh trend or an exhausted trend. A fresh trend is usually more powerful because you have the opportunity to capture a larger portion of the move. This is attractive because you are entering early in the trend, which can potentially lead to larger gains. On the other hand, an exhausted trend occurs after the market has already moved significantly, and traders may begin taking profits. However, an exhausted trend does not automatically mean you should immediately enter a short trade. A market can remain overbought longer than you expect. The third factor is higher time frames. Higher time frame charts help us see the bigger picture. They filter out a lot of short-term market noise and help identify stronger trends and key levels. That is why technical signals from higher time frames often carry more weight than signals from lower time frames. In InvestorHubX, we generally define higher time frames as the weekly and monthly time frames. The fourth factor is support and resistance levels. Support and resistance levels found on higher time frames generally carry more weight than those found on lower time frames. These are also known as key levels. To identify support and resistance levels, we look for factors such as swing highs and swing lows, multiple rejections at support or resistance levels, strong or drastic price movements, previous resistance becoming new support, previous support becoming new resistance, obvious price levels that stand out clearly on the chart. The fifth factor is divergence. Divergence happens when the price and an indicator are moving in different directions. These indicators can include the RSI and the stochastic oscillator. Divergence tells us that even though the price is still moving upward, the momentum behind the move may be becoming weaker. As a result, it can signal a possible trend reversal. The sixth factor is price action. Price action refers to how price moves on the chart, especially through candlestick patterns. Price action helps us understand what buyers and sellers are doing in the market right now. Common price action signals include doji candles, bullish engulfing candles, and bearish engulfing candles. A candlestick pattern becomes much stronger when it appears near important areas such as support, resistance, or higher time frame key levels. The seventh factor is chart patterns. Chart patterns help us identify possible trend continuations or trend reversals. Some common chart patterns include the cup and handle pattern, double bottoms, double tops, and bull flags. For example, a double top can suggest that buyers are losing strength and the market may move lower. A double bottom can suggest that sellers are losing strength and the market may move higher. Chart patterns become much stronger when combined with trend analysis, support and resistance levels, higher time frames, and other factors we discussed earlier. The more factors that align together, the higher the quality of the trade setup. The eighth factor is moving averages. Moving averages can act as dynamic support and resistance levels. Price may bounce or reverse around these levels because many traders watch them closely. Common moving averages include the 200-week moving average, 200-day moving average, 50-day moving average, and 20-day moving average. Different moving averages can be useful for identifying long-term and short-term trends. When a moving average aligns with other trading factors such as trend, support, and resistance levels, or chart patterns, it creates stronger confluence. The more factors that align together, the higher the probability of the trade setup. The ninth factor is Fibonacci levels. Fibonacci levels are used to identify possible support and resistance areas on a chart. Traders use Fibonacci retracement levels to estimate where price may pull back before continuing its trend. Common Fibonacci levels include 0.382, 0.5, and 0.618. These levels are important because many traders watch them closely. However, Fibonacci levels should not be used alone. Fibonacci becomes much stronger when it aligns with other factors such as trend, support, and resistance levels, moving averages, or price action signals. The more factors that align together, the higher the quality of the trade setup. The 10th factor is trend lines. Trend lines are lines drawn on a chart to connect important swing highs or swing lows. They help us identify the direction of the market and possible support or resistance areas. A breakout happens when price moves above a trend line. This may suggest buyers are becoming stronger and the market may move higher. On the other hand, a breakdown happens when price moves below a trend line. This may suggest sellers are taking control and the market may move lower. Trend lines become much stronger when combined with other factors such as support and resistance, price action, and higher time frame analysis. The 11th factor is time frame confluence. Time frame confluence happens when multiple time frames give us the same trading signal or support the same trading idea. This is important because different time frames tell different parts of the story. Higher time frames help us see the bigger picture, while lower time frames help us find more precise entry points. The more time frames that align together, the higher the quality of the trade setup may become. However, time frame confluence does not guarantee success. It simply increases the probability of the trade. The 12th factor is area of confluence. An area of confluence happens when multiple technical factors come together at the same price level. Common factors can include support and resistance, moving averages, Fibonacci levels, trend lines, and price action signals. The more factors that align together, the stronger the trade setup may become. Now that we understand trade quality, let's look at an example of a high-quality trade setup. This is Nasdaq on the weekly time frame. The first trade quality factor is that this is a higher time frame. Higher time frames generally carry more weight than lower time frames. The blue line here is the 200-week moving average, which acts as a dynamic support level. Next, we draw the key levels where previous resistance becomes new support. After that, we draw the Fibonacci retracement levels. As you can see, multiple factors are starting to align in the same area. This creates an area of confluence and increases the quality of the trade setup. There are two high-quality trade setups. The first one is here. First, the entry is at a key level. It is also where the 200-week moving average is located. it is also where the 0.5 Fibonacci level is located. We now have multiple factors aligning at the same area. This creates an area of confluence. In addition, this trade is on a higher time frame, which gives it more weight. This is an A+ setup. The second high-quality entry is here. Again, this is on the weekly time frame. As you can see, price bounces from the key level. This key level is significant because previous resistance has now become new support. Price is also reacting at the 0.382 Fibonacci level. However, a reaction alone does not automatically mean we should enter the trade. To confirm the entry, we draw a trend line here like this. As price breaks above the trend line, it confirms a potential change in trend. This gives us another A+ setup. And this is where we enter the trade. Understanding trade quality is only half the battle. The other half is consistency. Many traders know technical analysis, but they keep making the same mistakes over and over again because they never track their trades. Professional traders do not simply enter a trade and forget about it. They record every trade, review their mistakes, and learn from their wins and losses. This is where a trading diary becomes extremely important. A trading diary helps you understand questions like, why did I take this trade? Did I follow my strategy? Was this actually a high-quality setup? What can I improve next time? That is why I create the InvestorHubX trading diary. Inside the diary, you'll find a trade quality scorecard where you can score every trade based on the factors we discussed in this video. You can record your entries, exits, emotions, mistakes, and trading decisions. Over time, patterns begin to appear. You may discover that your A+ setups perform much better than your C-grade setups. Instead of guessing, you begin trading based on data. Because the goal is not just to take more trades. The goal is to take better trades. If you'd like to learn more, check out the InvestorHubX trading diary below. If you find this helpful, please visit InvestorHubX.com for more lessons just like this. We are building a complete learning platform designed to help investors like you master technical analysis, stocks, cryptocurrency, commodities, precious metals, property investing, and more, step by step. You will also get access to custom indicators and in-depth video courses to support your learning journey and take your skills to the next level. To summarize, today we learned about trade quality, which is very important because it increases the probability of a successful trade setup. We also looked at how to identify and enter trades based on trade quality factors. Lastly, we learned that keeping a trading diary is very important because it helps us identify our strengths and weaknesses, break bad trading habits, and improve our trading decisions over time. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.